Welcome to part 3. I'm Hindol. We have covered the 3 valuation approaches, and today we are going to deep dive on the most powerful and the most misunderstood, the discounted cash flow analysis. We are building this from first principles, so whether you are a CFO, an investor, an entrepreneur, you will understand not just the mechanics, but the logic behind every assumption. So what is a core formula and then what it really means? The DCF formula is deceptively simple. It's a value of a business which equals the present value of all future free cash flows. So now let's unpack what free cash flow actually means. It's not net income, it's not EBITDA, it's the cash the business generates after all the operating expenses, taxes, and necessary capital expenditures. The cash available to all capital providers are taken into account. And the formula is very simple. It's operating cash flow minus capex minus changes in the net working capital. This is what is actually available to be distributed. And why do we discount? Because a dollar today is worth more than a dollar tomorrow. Time has value, right? Risk has a cost. So the discount rate, it captures both. Here's the insight that most people miss. DCF is not primarily a forecasting exercise. It's a framework for understanding the value drivers. When you build a DCF, you're forced to articulate your thesis about what makes this business valuable. And then, what are the next steps? You build your projections. So let's go ahead and build this step by step. You start with your revenue projections, but revenue doesn't appear magically. You need to understand the revenue model. For a subscription business, it's a customer acquisition rate. It could be the retention rate and the average revenue per user. For a manufacturing business, it's units that are sold times price, driven by capacity utilization, by the market share. I always start with the unit economics. Can you articulate how value is created at the transaction level? If not, your projections could just be a wish list. Next, you look at your cost structure, separate the fixed from the variable costs, understand the concept of operating leverage. As revenue scales, which costs scale linearly and which are fixed. This drives margin expansion or margin compression. Working capital is where many models go wrong. As you grow revenue, you typically need more inventory. You extend more receivables. This consumes cash. The change in working capital is a cash outflow that reduces free cash flows. Then you look at capital expenditures. You distinguish between, let's say, maintenance capex, what you need to spend just to maintain the current operations, and then there's a growth capex, what you are investing to expand. In mature businesses, maintenance capex might equal depreciation. In growth businesses, however, total capex significantly exceeds depreciation. So here's a practical tip. Your projection period should match the visibility of what you actually have. For a stable, mature business, I'm comfortable with 10-year projections. For an early stage tech company in a very dynamic market, 5 years is really pushing it. Be honest about the uncertainty. Now, there is the bigger element in the DCF model, which is the terminal value and the discount rate. And here's the reality of DCF. 60 to 80% of the value typically sits in the terminal value. That is a value beyond your explicit projection period and is captured in one single number. And there are 2 approaches to that. There's a perpetuity growth method and the exit multiple method. The perpetuity growth assumes that the business grows at a constant rate forever. This rate should never exceed GDP growth, typically what, 2 to 3% in the US? Why? Because no company can grow faster than the economy indefinitely without becoming the entire economy. Like the speed of light, that's a cap. Exit multiple assumes you sell the business at the end of the projection period for some multiple of EBITDA or revenue. This is more practical but reintroduces market-based thinking into your income-based approach. I prefer the perpetuity growth for its theoretical integrity. But I always compare it to exit multiples as a sanity check. Now let's talk about the discount rate for a second. For enterprise value, you use the weighted average cost of capital. It is the blended cost of debt and the equity, and that is weighted by whatever your capital is in both those elements. And the cost of equity comes from the capital asset pricing model. It's a risk-free rate times plus the beta times the market risk premium. The risk-free rate is typically the 10-year treasury. Beta measures the stock's volatility relative to the market, and the market risk premium is the expected return of equities over treasuries, historically maybe 5 to 7%. So the cost of debt is rather your borrowing rate. You're tax affected because interest is deductible, is a shield. So here's a crucial point. Your discount rate must match your cash flows. If you're projecting unlevered free cash flows to the firm, use WACC. If you're projecting free cash flows to equity, use cost of equity. DCF is powerful when done rigorously, but it's garbage in, garbage out. Your valuation is only as good as your understanding of the business model and the industry dynamics. So what we'll do is in part 4, we'll tackle the market-based approach in detail and how to select comparables, how to adjust multiples, and how to avoid common pitfalls. See you then. Thank you.